Welcome back to Palisade Radio. I'm your host, Tom Bodrix, and joining me today is returning guest Lobo Tiggre. He's the author and publisher of theindependenspeculator.com. How are you today, Lobo?
Doing great, Tom. Glad to be back.
Great to have you. So you sign a lot of your updates with caveat emptor, and I wanted to get the meaning behind it and how it guides your investment philosophy.
Okay, well, it's Latin for buyer beware. And, it's kind of funny. You'd think, in a way, I am a salesman. I have a free newsletter. And as we all know, if you get something for free, you're the product, right? Obviously, I'm hoping that people who subscribe to my free weekly digest will do business with me on my paid services. And so it's kind of funny to say caveat emptor, buyer beware. It's sort of warning people. But, I know, and probably our audience knows that there's a lot of bullshit out there. And there's a lot of shameless promotion out there, not just on the part of the company executives trying to peddle their shares, but also, frankly, on my end of the business. So without naming names, pointing fingers, or getting my name on the short list to non-invitation to any future events, I just think it's the right thing to do to remind people that they are the buyers, that they should beware, and that there's a lot of people trying to sell them something. And you need to understand you're on the other side of the table of that transaction, and you should be cautious. Skepticism is a cardinal virtue for a speculator.
Absolutely, Lobo. And I think that's an important point. And I appreciate your perspective on this because, it's not necessarily about making predictions, but evaluating the circumstances around what could happen, right? And being able to make an informed decision based on, let's say, probabilities of certain scenarios happening. So I'd like to move on a little bit. Obviously, we've seen a lot of recent market fluctuations, and I want to get your thoughts on if they're presenting a buying opportunity or signaling to be cautious of another crash right now.
Sure. Well, there are several things to unpack in what you just said. As you and I speak, it is Tuesday, election day. I don't know when this will go live, but just so the audience knows, literally, as you and I are speaking, there's these huge variables at play right now. Now, probably your audience knows, and I have said, and I'm not the only one to say this, that my perspective is that whether Biden wins or Trump wins, or almost any likely combination, or actually any of the combinations of Congress and the House, the Senate, and the presidency, they're all good for gold. Everybody wants to spend more money. They just, differ on how much, but they all want to spend more money. So there's more easy money on the way. And the Fed has said, for years, they're not going anywhere with interest rates. This is all extremely bullish for gold. So in a way, it's kind of a non-event, but not really. Trump has said that he will not shut the economy down again, doesn't wear a mask. Biden, more or less the opposite. These are pretty important variables. Another big shutdown has a huge economic impact. Normally I dismiss politics as being, the Democrats and the Republicans are the tax and spend or the spend and tax party. They're not that different to me as a libertarian. But in this particular election, and it'll be passed by the time the audience hears this, but I think it is important because there could be very near-term, huge macro consequences of the different leadership in the White House. And I think that's important. So too late to say, go vote this way or go that way. But these are important variables. And I think that depending on how the outcome of the election goes, you will need to consider that. Now, most people have thought about the part of, well, there's more easy money and that's likely to be great for stocks and great for gold, great for a number of things. I think what people haven't really thought about is, if there are more draconian shutdowns on the way, what does that do? And I think more specifically to investors, a lot of investors seem to have made peace with the idea of a Biden. And if he's going to be sending more money that'll go to Wall Street, great. But if he's going to tax your profits, does that money do you any good? And I really think that Wall Street is discounting the Biden-Harris tax agenda, which I think is really quite serious. And if they do get the majority in the Senate as well as the House, I think that would actually be a pretty adverse reaction. I think most investors are probably thinking, divided power, status quo, government gridlock, but more money. So that's fine. But if you get rid of the government gridlock and suddenly you have, this democratic sweep with a mission and an agenda and a majority to push it through, I think that could alarm investors even before Biden could take office in January. So I do think there are outcomes here that have potentially big differences for investors in the near term.
Excellent. So what are some of the risks to mining companies if we see a Democratic victory today?
I know there's been commentary written about this, and I don't want to call out any names again here, but I have several questions from my readers about this. So the way that the particular question was framed and has people all stirred up and alarmed is a big headline about this is going to be terrible for gold stocks. And not just US gold stocks, but gold stocks. So there are a lot of people out there who are worried that all gold stocks are going to get whacked if there's a Democratic majority in both houses and Biden wins the presidency. I think that's overdoing it. Clearly, that would not be good for US mining in general. And the regulatory response of Democrats having power, reversing some of what Trump did with the EPA, passing new laws, higher standards and things, that's serious. That takes some years to work through. And it may not affect all mining equally, because we know that even the Biden administration is pro-advanced nuclear. And who wants to depend on the Russians for your uranium? So, and that's oversimplifying. But, what I'm saying is it's not a foregone conclusion that Democratic sweep would be bad for all mining. We also know that a lot of the green energy revolution needs minerals that are in scarce supply. And so I could actually see a Democratic majority being pro-mining, at least the kind of minerals that they need to achieve their visions. So I don't think it's guaranteed in any way that a Democratic sweep would be bad for all mining in the US. Now, gold, is that a necessary for the new vision? No. So it might be worse for gold, but that would take time. And, the producers that are already in production, it's hard to just turn around and yank their license just like that without any how to do. So probably the most vulnerable would be exploration projects for non-essential minerals in the US, because it would be easy to have the bureaucracy gum up their exploration permits and so on. But even that, it's not a foregone conclusion. Let's see what happens. There's jobs at stake there too, and the politicians know that, whatever promises they make on the campaign trail. But the bigger answer is, don't forget that the US is a tiny part of the overall mining picture of the world. Even though Nevada itself is a big gold producer, it's down there on the list behind China, a number of other countries. If it was a country, I think it was 6 or 7 last I saw, something like that. So possible changes in the US are not a threat to the entire industry. Don't panic.
Excellent. So after a record run that we've seen earlier this year, we're currently going through a normal and healthy period of consolidation in the metal space. So absent a broader market crash that puts a temporary squeeze on gold and silver, what types of moves are you expecting from the metals? And what would happen if gold did nothing, i.e. fluctuating sideways for a couple of years?
Sure. Well, I think it's an excellent question. Before we get that, and this relates to something you asked earlier, I didn't cover, sorry about that, but I do think there is potential for a crash. I know there were some people who predicted a big crash before the election. Hasn't happened yet. Or maybe the election will cause the next big crash. That might happen. I don't know. We'll see. Whether it does or it doesn't, my feeling is, though, that all that easy money has created a bubble on Wall Street. I'm not the only one to say this. And yes, more easy money could inflate it bigger, but it could also create a panic where people just suddenly wake up and realize, this is overvalued. Do I really want to own these things? And it won't matter how much money is being printed if people don't want to own stocks in general. So I do think there is a significant chance of a market crash. I think the market deserves a crash. It's way overvalued. I'm not going to predict when or what the pin might be to cause that to happen. But I wouldn't dismiss that. I think that card is in the deck. I wouldn't be surprised if it was close to the surface. And I'm personally not buying a lot. I did do some buying and I did pretty well this year, but now I've cooled my jets quite a bit and I'm accumulating cash, because if we do get that crash, I want to have a lot of cash to be able to buy, average down, buy new stocks that I missed before at stupid cheap prices. Would love to do that. So that having been said, let's say it doesn't happen, the money printing, status quo, everything's fine.
Sorry, Lobo, before we move on, could you kind of contrast for us how you think that gold mining equities would do in a crash versus normal equities, and what your thoughts were to keep cash on the side in such an event?
Yeah, well, my thoughts for keeping the cash, and by the way, not selling. I'm not selling everything and waiting for the crash, because we may not get a crash. And if I sell everything and the money printing does send everything vertical again and I'm left behind, then that would not be good. So I'm not selling and waiting for a crash. I'm accumulating cash from other sources. I have taken some profits, I will admit. So I have some big wins, and rather than let them slip through my fingers, I put what I call an upside maximizer on them, which is a form of stop loss to keep my gains intact. And I've taken some profits. So I'm building cash in case I get that opportunity. If I don't get that opportunity, I'll still have the cash and I'll have plenty of things to buy in what we're going to talk about next. But in terms of, will gold be spared? No. I think you might have been able to make that case if the next leg down in the crash had happened after a dead cat bounce in April or May, because a lot of the liquidity was squeezed out of the system at the time. People were not so far out on margin after the March crash. So that might have been true then. But now it's happy days on Wall Street again. People are way out on margin again. And gold has made at least nominal all-time highs, bringing a lot of generalist investors in, even Berkshire Hathaway, into a gold stock, not gold itself. So I think there's a lot of generalist money in this space. I think even Robin Hooders, and I know that's a gross generalization, they're not all millennials, but a lot of them are. And we've seen from the Robinhood data before it got pulled that the gold stocks and the gold ETFs and so on were getting a lot of interest from younger investors. So there's a lot of money there that I think could easily panic and go out if there's a big crash. So I do not think gold would be spared. And of course, if gold drops and silver, the stocks will drop more. So don't kid yourself that this time is different, that somehow a gigantic market crash won't affect gold stocks and silver stocks. I think that would be a very risky assumption to make. Now, that said, as I previously said, I'm not selling anything because of that, because at least the kind of stocks I own, I think all of them have the right stuff to come through a crash. They're the kind of stocks that if they do go on sale, if the baby gets thrown out with the bathwater, that's the baby I want to catch, and I want to catch more of them. I'd like to buy more. So my general thesis here is I'm not selling anything because there might be a crash. I'm building as much cash as I can in other ways because there might be a crash. And if there isn't, I'll still have the cash to deploy. And coming to your previous question, so what happens if we just go sideways? It does nothing. Well, that would be great. This is 1900. That's a fantastic gold price. I remember when $1,000 was this lofty goal on the upside that would be, a dream if it came true. And then 1,500 became this wonderful price that everybody would make money at. And we've exceeded that. And you can now, with a straight face, do a feasibility study with $1,300, $1,400, $1,500 gold that's below spot. So nobody will think you're crazy. Even on a long mine life project, you could project $1,400, $1,500 gold and people won't laugh you out of town. So, those projects look good. The miners are making money. The ones that aren't grossly incompetent are just seeing huge cash flow. So I think actually nothing happening, that would be sort of like an ideal thing that almost never happens. In the mining space, the underlying prices are so volatile that we consider ourselves lucky if they spike above what we need for a while and, hold on. For things to actually be steady, for you to actually be able to project what your income will be next year and be reasonably certain that it's right, that almost never happens in the mining space. That's a fantastic thing. So I would not complain at all. But if things are going flat, I understand that the stocks themselves aren't going to be going vertical the way that the junior miner speculator likes. But I'll tell you what, though, there is one way that this works out. Nothing happens, gets boring, the generalist investors start bailing, fine. Mining is a self-depleting business. Every mine, every ounce or pound you take out of the ground makes it that much smaller. If you don't explore and find more, if you don't replace those ounces and pounds, you literally mine yourself out of business. And exploration is difficult, it's tricky. Even for the best in the business, it often doesn't work out. And we all know that exploration budgets have been slashed over the last 10 years. So I think this is a key here for people who are worried about things just sort of, for a while. Look for takeover targets. The big boys, they have to buy the smaller companies that have made discoveries, and even the mid-tier and so on down the line. They have to buy these discoveries or they will mine themselves out of business. They will become smaller every year if they don't replace those resources. And when you have a takeover bid, a modest one is 20, 30% overnight on a takeover bid. Some of the more generous ones can be 50% or 100% overnight. So this is one of those things where if you can accurately predict a takeover target, a day late is too late. Mm-hmm. I mean, maybe not entirely too late. There can be some arbitrage opportunities or something. But that big leap on the bid, by the time you hear about it, it's behind you. So you want to position yourself for takeover targets. And this is something that could make people real hockey stick type returns in their speculations, even if gold and silver go nowhere for years.
So that actually does bring me into the next question that I had for you, Lobo, is what are the types of projects that define a takeover bid you have your eye on for a possible M&A?
Yeah, well, the quick answer is margin is king, and you should look for high margin projects, and that works up and down the scale. The takeovers, typically, we look at what the question is framed as, what would interest the majors? Those are the guys with the big coffers, flush with money now after these nominal record high gold prices and 7-year high silver prices. They've got lots of cash. And by the way, real quick, the COVID situation has affected this. It's very hard to go do due diligence when you can't travel, or, if you're a small company, exploring in some village somewhere, and there's a COVID outbreak after you have a tour, your social license will be destroyed. So my understanding from sources in the industry is that the due diligence process has really stopped this year. And I'll tell you, due diligence is my thing, going around and kicking the rocks before I pick the stocks. And I've only gone on one trip this year, and that was in January. So I think there's been a pause in the M&A activity in the space. It's needed. And the longer the pause, the more pressure there is to make these purchases when it starts happening again. But what I'm saying is that the first likely suspects are going to be the majors, because they have the most money and they have very high production rates. They need to replace that. So for a major, it's sort of rule of thumbs that you're looking for at least 5 million ounces gold equivalent and district potential. A single 5 million ounce deposit by itself isn't necessarily enough. You need to be able to convince the major that if they buy this mine, that there's more down the pipe coming ahead. So margin is still king. And the larger producers have actually bought considerably smaller assets than that they thought had high margins and long mine lives. That's one thing. But we also have the mid-tiers, right? The mid-tiers have lower thresholds. And you'll also see mergers amongst smaller producers and explorers. So without getting into too great technical details, you want to look at the metallurgical recoveries, you want to look at political risk, you want to look at infrastructure advantages, all these things. But the bottom line is margin. And if there's even a preliminary study, but hopefully a pre-feas or a full feasibility study, you want to look at the margin. And if the margin is not at least a 15% internal rate of return, it's very unlikely that project will go forward. 25 starts becoming more interesting and closer to, takeoverable. Above 25, 30, it starts getting pretty robust and pretty exciting.
Excellent. I'd like to turn a little bit away from gold for the moment and ask you a little bit about the square root recovery that you wrote about. So how does the curve differ, especially as you're saying, for this square root recovery? I love that analogy, because if you think about it, that's exactly how this recovery has kind of gone. So how does that differ from Main Street and Wall Street?
Well, I'm not sure I'm quite the lone wolf on this that I was before, but basically things are so politicized, and I'm not trying to politicize anything, but it's funny how for different political reasons, there are people both on the right and the left who want to say there's a V-shaped recovery. And there's a lot of evidence you can point to that. You point to the job losses and back again, manufacturing and back again. There's a lot of V-shaped charts that you can do. The problem is that this side of the V after COVID is not as high as this side before. That's what makes it the square root. So the basic idea here is that if your post-shutdown level of economic activity or any other price or whatever you're looking at is significantly lower than before, you actually haven't recovered. You've lopped off the bottom of the worst damage, but you're not recovered, right? And let's say the overall U.S. economy comes screaming back up and it's 80% of what it was before. Great. Wow, 80% recovery. That's not great. That's a 20% decline from what it was before. Even a 90% recovery, fantastic. No, that's a 10% decline from what it was before. So I think it's important to not let what we wish were so, what we hope were so, what our politician needs to be so to sway our views as investors and as speculators. We need to be as objective as possible. And at least as I look at the economy, I see a world of hurt. And every time there's an employment number out, it's not as bad as last week, but it's still terrible. The best ones we've had are still well above the previous all-time records of weekly unemployment claims. This is a bad thing, and it has long-term consequences. So all I'm saying is we're not out of the woods. This has economic and investment implications.
Absolutely. So could we see, when we see the next aid package, how could that have the opposite effect of pushing off, as you were calling it, the Greater Depression?
Well, it's possible if you've got a patient who has been in a terrible car accident, heart stops, lungs stop, everything stops. You can put them on a mechanical lung, and you can put a heart machine in there. You can put a chemical liver in place and so on. But you can't unplug those things. So the way I see it is that this stuff that they're calling stimulus, it's not really stimulus. And until you actually have the patient healed until the heart beats on its own, until the lungs work, until the economy is actually working again, what you have is life support. And you can argue about how much stimulus to improve the economy might be good or bad, but you can't unplug life support if you don't want the patient to die. So that's why I think, left wing, right wing, the libertarians aren't going to get in and unplug the patient. So the life support's going to continue. Now, how long does it go? You could have the patient die anyway. You're not supposed to have a mechanical lung and a mechanical heart. And the body may deteriorate even with the mechanical lung and the mechanical heart. And I don't want to beat this metaphor to death here. But what I'm saying is, the situation is critical. And the government could throw, 10 times more money at it. But if they lose confidence or they decide to circle the wagons and we're going to hunker down here and not spend, and not hire and not build and just, go into turtle inside the shell mode, it could be that no amount of money printing really rescues the economy. It could crash anyway. And it certainly applies to Wall Street. There's a lot of people out there who are saying that, there can never be a bear market again. The Wall Street can't crash because they'll just print more money and everything will go up. Well, that's not necessarily true. Well, one, if Wall Street crashes and you print more money, you're printing the money after the crash. So the crash has already happened. And two, I think I mentioned this earlier, if people don't want to buy stocks, if they're afraid and they've just decided, thank you for the free money, I'm buying gold or I'm buying land or I'm buying whatever, something else that I see as less risky, you could see high money printing and low stock yields. So the assumptions that people have made, they've been trained to make over the last 10 or longer years, I think may not hold. But the point really to get back to your question is that we are in uncharted waters. When you shut down an entire economy, not just the US, but globally, it's never really been done before. Nobody really knows what will happen. At best, we have theories about what might happen. And the theory that printing more money will make everything well again has obvious question marks over it. So we don't know. I think without going back to my metaphors, before I can start calming down and thinking, okay, things are good again, I want to see stable, normal economic activity. I want to see manufacturing increasing around the world. I want to see mining increasing around the world, not because of subsidies or not because of favoritism or not because of easy money, but because of demand. Right? I want to see not just consumption, consumption for consumption's sake, but I want to see their standard of living increasing. I want to see their purchasing power increasing. I want to see families better off. I want to see a healthy economy. Until that happens, I'm deeply skeptical that what has seemed to work before will necessarily do the job again.
So Lobo, as you were just speaking about people's purchasing power increasing, what flationary scenarios do you see as likely, not if, but when we get this next stimulus package?
Well, I do think that it is relevant. The stimulus, depending on how much of it goes directly to the consumer, I think that is more directly inflationary than fiddling with the interest rates and at the same time incenting banks to take too much risk. We slapped the hands of the banks for being so tone deaf to moral hazard and all this stuff. And said, subprime, that was all bad. Don't do that. But then we're also saying to banks, well, what's wrong with you? Why aren't you lending all this money that you have now? Right? So you can't tell the banks, don't be so foolhardy and go lend out more money, darn you, when people don't have jobs and so on. So it's a really mixed bag. But I think that one of the keys, two key points. One is those of us who are hard money advocates believe, as Friedman said, that inflation is always a monetary phenomenon. So why haven't we had inflation since 2008? And of course, now the monetary theory folks are saying, see, look, you can print all you want and it doesn't cause inflation. It's wrong. Printing money doesn't cause inflation. Well, that's oversimplifying. It's not true. I mean, they're conveniently forgetting velocity of money. So if the Fed incents banks to keep excess reserves on, if people are just afraid or unemployed and they are saving more or spending less, then the velocity of money comes down. And so, yes, money printing can be offset by lower velocity of money. That does, in a fractional reserve banking system, that does matter. If you had just gold coins and that was it, flooding more gold coins, there would be no velocity of money dampener, right? So you'd see a direct consequence. So what I'm saying is don't fall for this argument that low inflation since 2008 or specific response after the big money printing's last crisis means that we're safe and we can print all we want now. I think that's a very flawed conclusion to draw. So that having been said, yes, I do fall in the inflation camp. We may see more deflationary pressures in the CPI sense. I know the monetarists or the monetary inflation guys will say inflation is money printing. I understand that. But if you're talking consumer price inflation, well, price inflation can see deflationary pressures from unemployment, from dampened velocity of money, these other things. So I think, but that would be short term. And the real kicker here is that the more overconfident you become because of other factors dampening or masking the impact of your money printing, the more likely you are to overshoot. And so I really do think that's what's going to happen. I think we're going to see the powers that be pushing the, oh, look, we got away with it. Let's print more. Oh, look, we got away with it. Let's print more. Let's lend more. Let's create more. And then when inflation, they finally get it, it's going to be very, very hard to control. I think we're going to see very high inflation levels for years as a result of what's being done. I do agree that for it to become hyperinflationary, it would have to go into a death spiral. What's been done already is not enough to be hyperinflationary. It would have to spark more printing and then, more crisis in printing and then go out of control to cause that. But what's been done already, I do think is enough to cause much higher inflation ahead. And if the Fed keeps interest rates artificially low, I mean, they may be forced to raise them, but if they're lower than the inflation rates, we'll still have real negative rates, which is bullish for gold. So long way of saying, I'm in the inflation camp, regardless of the near term, and I see it as extremely bullish for monetary metals, by which I mean specifically gold and silver, not platinum or palladium or rhodium.
Very interesting, Lobo. So considering all the eyes that we have on the gold space, especially since we've seen Buffett take a stake in Barrick, can you tell us a bit about the other bottom feeder opportunities in your eyes?
Yes. Well, you skate to where the huck is going to be, according to the great Canadian philosopher Wayne Gretzky. So I want to say that first, I can't call gold and silver bottom feeder opportunities. I do think they're going much higher. I do think that a double from here is realistic in gold, and a triple or quadruple, like triple digit silver, I think is possible in the high inflation environment and the whole sort of monetary environment that we have in front of us. So I don't want to just write them off and say, oh, it's too late, forget about gold and silver. No, I'm not saying that at all. But clearly, these are not stealth opportunities. When you have Buffett buying Barrick and generalist investors piling in, these are not stealth mode opportunities. One much hated and reviled commodity out there that still counts, I think, is uranium, despite the fact that uranium has had a good year and remains actually having a good year. It's retreated a bit, but it's still close to $30, which is certainly a lot better than 18 a couple years ago. But it's still, people don't want to hear about uranium. They've heard the fundamental arguments for uranium for years, and it's gone nowhere. It's still below the cost of production. I think that's a fantastic thing. If you're a contrarian speculator, you want to know about opportunities in something that's necessary, can't be replaced, can't be produced at current prices. Everybody hates it. I mean, uranium just ticks everything off. The one caveat to this, I do see it as a when, not if question, and I do think it's going to happen soon. But I always warn people about this. This is the high risk end of my personal portfolio are my uranium stocks, because another nuclear accident would put everything on ice. I don't think that's going to happen. Obviously, if I've invested in my own money in uranium stocks, I'm not planning on that. But I just wouldn't want anybody to go and buy uranium stocks and then have something like this happen and say, oh, Lobo, you lied. You said they were going up. So I want to put that caveat out there. The other thing is, I do think that all the money printing, I've come down on the inflation side. I do think that's bullish for basically all commodities. And even if we have low economic activity, I think it's incorrect to assume that that's going to be bad for industrial minerals just because of the inflationary. There is such a thing as stagflation, right? The Keynesians were wrong. The 70s showed that you can have low economic activity and high inflation. That's actually my base case forecast for as this all goes forward. If we don't go into a hyperinflationary scenario, I see a long period of stagflation ahead of us as a consequence of what's been done this year and before. That's very bullish for all commodities. It's bullish for industrial metals, but some of them are more in short supply than others, and they fit in the narrative of this electric revolution, particularly copper, nickel. There's been some new research saying that nickel might actually not be in such short supply in the nearest term, but going forward, there are supply constraints on nickel. There's a lot more nickel in a lithium-ion battery than there is lithium, and there's a lot more copper in an electric car than there is lithium. And both of these face long-term structural supply constraints. So I wouldn't quite call these stealth opportunities. There are a lot of people talking about them, but their prices are still relatively low compared to where I think they're going. And certainly the companies, there are stocks out there in these metals that I think have a lot of upside. The one caveat there is if we do get another market meltdown, or if COVID shutdown stage 2, puts the economy back in the deep freeze again, as we've seen oil prices already sensitive to this, I think we will see industrial minerals, other industrial minerals sensitive to this. So there is a potential for near-term downside. Frankly, I'm watching for that. And that's when I think would be the buying opportunity. I'm not really looking to back up the truck right now on any of these more contrarian opportunities. I'm looking for that next COVID shutdown, which I think is coming. Europe's already doing it. I don't know if Trump will be able to resist, if he wins, if he'll be able to resist. The states can shut down even without Trump. So if there's a second wave of, never mind the medical effects, but if there's a second wave of fear and if there's a second wave of shutdowns, I think that could create terrific buying opportunities in not all industrial minerals, but the ones that are really important, necessary, hard to replace, and will be hated at that time.
So the only one we didn't really touch on is oil. Could we get some of your thoughts towards, obviously we saw negative oil prices earlier this year. And what do you think the considerations that one would have with oil going forward?
Yeah, I think that I'm not the only one to say this. That was a fluke. I don't think that's likely to happen again. People will be on guard against it. But I do think we could see lower oil prices right ahead. And we've seen it already just in the last week. When Europe shut down, there was a knee-jerk reaction of oil prices dropping. The bottom line is that, one, oil's not going away. Yes, I do believe that the world is switching to this new electric paradigm, but that takes decades. Decades. Absent COVID, the statistics are actually that, gas-powered vehicles the sales are still increasing. So, oil isn't going away right away, but there is a glut. And the only reason why prices have somewhat normalized is an enormous amount of self-restraint on the part of the producers. So, that's not a very bullish environment. Even if, there's a vaccine, everybody goes back traveling again, everything's fine again, prices may go up for a while, but remember, those voluntary restraints start coming off, that supply starts coming back on again. I think it could take quite some time for that market to really equalize itself out and for supply and demand to produce a stable price environment. So I think it's something to be extremely cautious of in the near term. As the next wave of COVID shutdowns accelerates and deepens, I don't know how much that will be, but that's directly negative for oil in the near term. And there's potential for a lapse of discipline on the part of the OPEC Plus members that could keep that supply glut going. So you just got to watch this. But at some point, and by the way, this is something I will talk about in my free service. My paid service is about what I'm doing with my own money. My free service is my market observations, the kinds of things you and I are talking about. So when I'm looking at this and when I'm thinking it's safe to get back in the oil patch, like these things have resolved themselves. And now I can see, okay, we still have years ahead for oil. And now I'm ready to get back in again. That is something that I would telegraph in the Speculator's Digest. I write it once a week. And all the things you and I have been talking about are the kinds of things that in general I discuss in that free newsletter. So without tooting my horn too much here or being too salesman-y, I'm trying to say that not now, but when the time comes, I will be telling my readers.
Perfect, Lobo. Is there anything else you'd like to mention as we wrap up here?
Well, we talked about the takeovers. There's two other just general strategies I'd like to briefly mention. I think we've talked about before. One is what I call the pre-production sweet spot. That is first-time mine builders. The statistics on this are still very robust. Bull market, bear market, not as great in a bear market, but they tend to deliver significant gains for shareholders between a construction decision and the first production. So that is something to look at, whether prices go up or even down, or whether they go sideways, like your question. The pre-production sweet spot is something else besides takeovers that people can look for. I have a free report on the pre-production sweet spot that people can download from our website. And the other one would be something that I call success in progress. Mr. Market always loves a success. I remember very keenly, there was a company that put out something like 10 meters of 400 grams per ton gold. It's just honking fat, high-grade gold intercept. And it was like late November 2008. It was just, the worst vertical part of everything crashing and falling down in 2008. And that stock popped on that drill result. Because, even in the worst case, when you have something that's really, oh, wow, the market loves a discovery. So prices going up, prices, faltering, prices going sideways. The market loves a discovery. So if you can identify candidates that are either the higher risk would be pre-discovery, but that are making discoveries, that there's a success in progress. There's another free report you can download from my website on the success in progress play. There's a pattern here that I've identified that anybody can use. And these are things, opportunities to look for going ahead, whatever happens with these unknown variables we've been discussing.
Excellent. And the best ways to find you are at theindependenspeculator.com and at Due Diligence Guy on Twitter, correct?
That's right. Thank you.
Perfect. You also have a free live geology Q&A on December 5th coming up on YouTube with Brent Cook and Ron Parrott. Tell us a bit more about that and what listeners can expect if they tune into that.
Well, thank you so much for bringing that up. It's just one of those things where I get questions all the time about the geology. And even though I look like a geologist sometimes, I play one on TV, I'm not actually a professional geologist. I've just been kicking a lot of rocks for a lot of years. So I thought, readers have been asking me for a long time for a Q&A session, and particularly when you get these press releases from the companies and there's all this geo jargon in there, and what the hell does this mean? I've been doing this for almost 20 years, and I still sometimes have to go look up the terms that they use. So I get it. I understand why people want help with this. But again, I felt a little self-conscious of, I know a lot, but I'm not a geologist. So that's why I pulled in two geologists I respect the most. Brent is actually a competitor of mine in the newsletter business, but he's one of the most brutal about calling a spade a spade. So I really trust his judgment. And honestly, he was here before me, and he's one of the people that taught me some of the tricks of the trade. So I like him and I respect him. I wanted to invite him. And Ron is one of the most successful mine finders I've ever met. Multiple multi-million ounce gold deposits to his credit, or he was on the team of, right? And he's also one that I've known for many years, driving around Nevada, kicking rocks and just peppering him with questions all day long. Just indefatigable, never gets tired of answering, explaining in simple terms that even I could understand and so on. So I've had questions for a long time from readers, and I put these guys together to help me. I didn't want to make it too big because then it gets boring. So just a couple of guys, my angel and my demon over my shoulder to answer your questions about geology, everything you ever wanted to know but were afraid to ask, right? So you can read press releases and know what the heck everybody's talking about. You don't have to pay anything for this. It's free. You don't even have to sign up. Just come to YouTube at the right time. But there is information about this on the website. You can see the link at independentspeculator.com right at the top of the page.
Perfect. And we'll put a link in the show notes as well. Lobo, thanks very much for your time today.
Thank you, Tom. Have a great one.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?